The S&P 500 is down 6% as of Friday, April 4th, down 5% the day before. The Dow, a little over 5%. JP Morgan, the biggest investment bank in America, is warning of a recession. A lot of people are tense. Here are two strategies that you can use if you are nervous. Disclaimer, the S&P 500 has done pretty well over the last 5 years. We may not enter into a recession. We may enter into a recession and the markets still will likely outperform both of the strategies that we are going to go over today. The point is for anyone who is maybe 15 years, let's say, out from retirement, maybe just into retirement, anywhere in that range, you have options to have guarantees to opt out of this sort of situation or worrying during this situation. This past year, my name is Daniel McCluskey. We moved just over 1.3 million into these strategies, none of which any of these clients lost a dime due to this fiasco that's currently going on. Now, we all may miss out on some big returns if the market does rebound, especially if you are a believer in what Trump is currently doing. They, of course, expected this to cause short-term consumer pressure, but hopefully for the long term, there'll be an economic boom. Prices are said by Vice President J.D. Vance to lower in the long term. The Americans will start to feel it in a good way in their pockets long term. They've got about 3.5 more years to do that. Regardless, if you'd like to opt out of that volatility, we're going to go over two strategies here today. The first is going to be what sales are up in the past 3 years in over 100%. You can see in 2021, the fixed, not index, indexed annuity sales were 63.7 billion. According to Google, 2024, 125.5 billion, up 31% from the year before. That's over 100, just under 100 actually, for the past 3 years. And that is the fixed indexed annuity. LIMRA projects strong annuity sales through 2027, despite what a lot of financial advisors, for example, might say, that people dislike them because they return lower historically and most likely are to return lower. However, even though that is pushed out into the world through most advisors, and while they may not be wrong about the returns and whatnot, people who are retiring or pre-retirees are starting to realize that there is a form of optimization outside of the highest possible rate of return and a portfolio. But there's also an optimization for the one thing that almost all of those arguments don't take into account, and that is peace of mind or a lack of stress. And that is exactly what these two strategies are built for. The first is the more deferred income annuity, deferred fixed indexed annuity. That is essentially where you are indexed to an index. You are linked to an index, meaning if that index goes up, you will participate in that gain. You'll be able to reflect whatever that index does, depending on how it's set up with caps and participation rates, up to usually a cap. Meaning if the market does more than 10% and you have a cap of 10, then you're only going to get 10. But the catch, or not the catch, but the pro to that cap is that there's also a floor of 0%. Meaning if the market goes down in any given year, if 2008 happens again, if this happens again, if this past year happened again, it looks like as of today, the market is down 1.5% in the last year after this crash, so all of those gains from last year kind of got wiped out. If that was the case for you, you would have hit a floor of 0. You don't lose when the market goes down. So that is the trade-off for having a cap. You are capped on your upside, but you're completely protected from the downside. And if you defer an annuity, an income annuity, that is a fixed index annuity, out 15, 10, 7, 5 years, usually, and you set it up to plan to take income at that time, and you can always be flexible with it. So if you set it for 10 years, but you don't decide to take it until 12, that's totally fine. The insurance companies, since you are locking the money up, since you are setting it up for income and planning for that from the very beginning, are going to be able to offer much greater guarantees. Currently, interest rates are as high as they've been in quite a while, at least on average. We've had a couple cuts in the last couple months, or last 6 to 8 months rather. However, they are expected to continue to drop. When those drop, guarantees from insurance companies, of course, are going to drop because they are tied to these interest rates. A lot of times insurance companies are investing most heavily in bonds, a lot of loans as well in real estate. However, most heavily in bonds, which are going to be tied to this interest rate. And when those lower, they have lower guarantees. So currently, I just had a 56-year-old female, an illustration that I ran, taking immediate income, that's no deferral period, was getting a 6.3% withdrawal rates guaranteed for the rest of her life. Now that does not inflate. That doesn't count for inflation. But 6.3% guaranteed rest of her life, that's a 56-year-old. Imagine if that was deferred 5 years. If that was deferred 10 years, about doubles on average, maybe a little higher than doubles guaranteed for the rest of her life because she'd be later into life, 66. Usually going to be able to offer a higher percentage at that point. The reason that's able to double is because they'll guarantee it's going to inflate by a certain percentage every single year. Usually there's a bonus up front as well. And if the fixed indexed annuity outperforms that guarantee, usually it doesn't, frankly, but if it does outperform that guarantee, you get that number instead of the guaranteed, and that's the number you can start taking income from, absolutely guaranteed by these insurance companies. That 6.36% example was the best on the market at the time. Again, that's a 56-year-old. If someone did that at age 50, at age 45, deferred it out 15, 10 years, had it more than double if it was over 10 years, and the withdrawal percentage would, of course, increase the older you get, you would be, of course, opting out completely of what's going on now. This is something to consider. Is it going to perform better? Might you get more income than if you had just kept money in the market and used a 4 or maybe got a little risky and used a 5% rule, at least according to the traditional industry standard with withdrawal rules from financial advisors? Would you maybe get more income doing that? Perhaps, and maybe it's even probable. I won't even say maybe, it is more probable that you would receive more income doing that. However, it's not guaranteed, and frankly, what you do to kind of prepare for retirement, putting money in 401ks, IRAs, whatever, is much different than what you're going to do at retirement. You might be able to afford a 10% market crash in 2 days when you were 30 years old. You might not be able to do that when you're 60 if the markets don't rebound quickly, especially as you're taking money out of those accounts. There's not as much money in there to rebound with. So another thing there to consider. But of course, we don't know. There is uncertainty. God knows if we're going to enter into a recession. JP Morgan predicts it. Even if we do, could come back. The point is, if there was a lost decade, like the 2000 to 2010 with the dot-com bubble and the 2008 housing crisis, where that happened, if you retired then, these guarantees might have been very nice. Not might have, would have been incredibly, incredibly nice. And for people who worry about things like that happening again, who saw the COVID crash and maybe didn't hold the whole way through it and didn't get to see the market come back again, people who are worried about those sorts of things would like guarantees. And it's also important to point out, There's average investor return, and there's the average return of the market, assuming you actually hold the market, depending who you ask, let's say 7%, 8%. The average investor return is closer to 3%. And that is because while everyone plans to buy and hold, they just don't when these sorts of things happen. That's why it's very tense right now with what's going on this past Thursday and Friday, post-Liberation Day from Trump, as he calls it, because people struggle with keeping money in the market. And of course, they're human beings. Of course, they're going to losing 10% of your money if you had $1 million portfolio, losing $100,000 in 2 days, regardless of if it's going to come back or not, if you're not checking it or not, is something that is going to hurt for people, at least emotionally. That's no argument to say that they shouldn't just keep it in there, but it is the reality. It's important to address that. And if you're deferring your money with guarantees attached to the income, this could be something to bring peace to that kind of situation. The second option, aside from deferring the money, is if you're more like that 56-year-old female who wants to take immediate income. Now, she was doing this with post-tax dollars. So if that's the case, then you can do this before age 59 and a half. But if it's a deferred account and you started doing that, well, you would have to take the 10% penalty, so you might as well wait an extra 3.5 years. But that's for her, the 56-year-old, getting 6.36% on her money every single year. Not on her money as a return, but that's the percentage of that money she'll get guaranteed for the rest of her life. Imagine if you are 60, 65, maybe you're in retirement, you've already retired. However, everything's in the market, most of it's in the market. You can still pick up some guarantees, start taking income immediately. You can still defer some of that out if you'd like to, and take a higher rate than 6.36% if you're older than the 56-year-old that we gave an example of earlier, and have that money guaranteed for the rest of your life. The point, again, I can't emphasize this enough, is not to earn higher returns. If you hear the common pitch of markets can't lose when they go down, only upside potential, win when they do, can't lose when you go down, beat the market, this is a stock market alternative, all of those things, it's nonsense. That's not what this is. It is just a way to guarantee and secure your future and your income. And of course, the main reason is to bring peace of mind to your situation. So these are two options. Again, they are increasing rapidly over the last 3 years. LIMRA, across all annuity sales, not just fixed index annuity sales, says despite expected declines, projects strong sales through 2027. Over 400 billion across total annuity sales in 2024, according to LIMRA again. So despite what you might read, despite what you hear from the traditional financial advisor and the financial industry, annuities are becoming very, very popular, and there's great reason that that's the case. It's not people that are very against the grain necessarily. It is a large group of people who are just looking for one thing, and that's peace. Hopefully this video was helpful. These are two different options that you have, and you can always consider: deferral, fixed index annuities that are flexible, or immediate annuities still can be fixed indexed for the amount that is growing while you're taking income. Both of these types of annuities, if you're doing with a guaranteed lifetime withdrawal benefit rider, that means as you are taking the income, it's still guaranteed that if you passed away early, that money that you didn't receive yet, that you put in, is going to transfer to your heirs. And second, that if you had an emergency, even though you did already turn on this income, you could still access the money, usually up to about 10% penalty free. Above that, you can pull out for a penalty. That penalty gets lower each and every year. However, much different than the more traditional annuities, where if you passed away early, you lost the money, and if you had an emergency or opportunity, you wanted to access the money, you couldn't do it. Not the case with the fixed index annuity with those guaranteed lifetime withdrawal benefit riders. There's tons of different riders. There's tons of different products. There's tons of ones with different fees. There's tons of ones with different guaranteed income. The one that I gave an example for was the best on the market currently. Make sure you run projections across different companies. You're getting one of the best ones, that you're getting a highly rated company, and that you are able to read into your illustration, see the fees that are on there, and make sure you're not getting ripped off. And make sure, most importantly, you're doing it for the right reasons. These are two options with what's going on right now. Guess we'll wait and see how things pan out. But hopefully you enjoyed the video. Subscribe. Release videos like this 3 times a week, going into more details just about retirement. I do a live stream once a week as well, going into some more strategies. Everything that I do specifically is outside of the stock market. Everything that I sell, I am commissioned for, full transparency. However, I try to be as objective as I can when making these videos and point out the pros and cons and what the main reasons that people might actually buy these sorts of products and strategies are. So hopefully this video was helpful. If you did enjoy it, subscribe, and I will see you in a future video. Bye-bye.